With every click, you're fighting a billion-dollar institution, and on their turf, the low timeframes, you are designed to lose. But we're not going to fight them there. We're going to pull them onto our turf, swing trading on the higher timeframes. So here is the plan. 3 brutally simple swing trading setups fused into one 10-minute daily routine so you can finally grow your account without being chained to the screen. The key to successful swing trading is combining good tools. You want strong reference points on the chart so you can see where price might pivot or pause. You want some tools that show volatility and trend. You also want to watch key levels that can trigger bigger moves. Basically, you look for Confluence. Multiple tools point to the same region. So let's talk about it. First swing trading approach revolves around monthly pivots. These lines are more influential than daily pivot lines for bigger moves. Institutions often watch these monthly pivot areas. They might cluster large orders around those lines. You will often see that price tags a monthly pivot and then bounces or breaks. People who trade higher time frames rely on monthly pivots as references. They can act as stable levels because they do not shift each day. If price is above the main monthly pivot, that can signal bullish bias. If it is below, that can signal bearish bias. Monthly pivots often pull price toward them. That is the magnet effect. Traders who missed prior moves sometimes wait for price to return to a pivot zone. Then they enter or add to positions. So you often see price reacting to these lines with strong wicks or consolidation. If you see price hold above the monthly pivot for several sessions, that pivot might be reliable support. If price stays below, that pivot may act as resistance. This can help you plan trades. If price is above the pivot, you can look for dips. If it is below, you can sell rallies. Confluence is key. A monthly pivot by itself might be good, but if you also see that pivot align with a demand zone or a supply zone, you have a stronger reason for a trade. A demand zone is a zone where buyers showed interest before. A supply zone is where sellers dominated. If the monthly pivot sits right around a known support area, that might be a prime region for a bounce. Then you can go long. Or if the pivot is near a supply zone, you might look for a short. You can also see monthly pivots appear near local structure. For instance, if the prior swing low was around the pivot, that line might become a stronger level. That is how you get synergy between structure and pivots. As a swing trader, you can wait for price to approach that zone. If the market prints a reversal pattern, you step in. This helps you avoid random trades in the middle of nowhere. In this chart, price has been dropping for a few weeks. You see that the next monthly pivot line sits just below price. At the same zone, you detect a prior demand zone, and when price gets there, a bullish pin bar forms. That can be your buy signal. You set your stop loss a bit under the pivot and demand zone. If price bounces, you ride the wave to the next pivot or to a prior swing high. This is how you catch swings that last several days. In this example, a monthly pivot coincides with a supply zone. As price rallies into that zone, you watch for a reaction. Perhaps you see a bearish pin bar or a bearish engulfing bar as price touches the pivot. That can be your short trigger, anticipating a downward swing. So you set your stop above the pivot, and you target the next monthly pivot line or a known support. Candlestick patterns reinforce pivot signals. A pin bar with a long wick rejecting the pivot is often a sign that the price attempts to break, but fails. That can lead to a reversal. An engulfing bar that closes back under the pivot after testing it is also a strong sign. If the pivot has acted as support for some time, but you see a daily close below it, that pivot may now turn into resistance. Try not to jump in without a pattern. Wait for some sign that the price is responding. Even on a 4-hour chart, you can look for a clear wick or an engulfing candle. That evidence helps you avoid false breaks. If price blasts through a monthly pivot that had held for several days, that can mean a change in direction. Let's say a monthly pivot was acting as support. Price slices below it, closes below on a daily candle, and then retests it from underneath. That pivot might flip to resistance. You then look for a short entry on that retest. This approach is a pivot flip trade. Many times, old support becomes new resistance, or old resistance becomes new support. That is a principle you see across many time frames. With monthly pivots, it can hold more weight. When you see a breakout occur, you can ride the momentum in that direction. Some swing traders prefer breakouts if the overall trend aligns with them. They wait for a pivot break and enter. They use the old pivot line as a place for a stop or a partial stop. If the pivot break is genuine, the next pivot might act as a magnet. That can be your target for a multi-day move. Another example, price forms a demand zone and the monthly pivot line is right there. The candle prints a bullish pin bar with a long lower wick, showing that sellers tried to push price down. You can go long at the next open and place a stop loss below the pivot. Your target might be the next monthly pivot or a prior swing high. If price breaks the pivot, you might shift your plan, wait for a retest from below, and short. Another good swing trading approach includes Bollinger Bands. A Bollinger Band is an envelope that surrounds price based on standard deviations from a moving average. For this setup, you'll use a 50-period basis, but you place 3 sets of bands, one with a deviation of 1, one with a deviation of 2, and one with a deviation of 3. That way, you get a layered effect. The middle band is your 50 SMA, a stable average that fits swing trading timeframes. These 3 bands help you see different zones of volatility. The first band with 1 deviation is tied to the average, capturing mild fluctuations. The second band is a broader channel that usually contains most of the price action under normal volatility. The third band is the widest, capturing extreme moves. When price pushes outside the outer band, that can show an extreme. If price closes beyond the third deviation band, it might mean the market is overstretched. Swing traders often watch for a reversion or a mean reversion at that point. They might look for a reversal setup. If price stays near the middle band, it might be trending or consolidating. If price tags the upper band area frequently, that might be an uptrend. If it tags the lower band area, that might be a downtrend. The layered bands also help evaluate the strength of a trend. If price keeps hugging the outer band without snapping back, that's a strong trend. Some traders fade extremes at the 3 deviation band, especially if they see a candlestick reversal pattern. Others wait for a cross of the middle band as a sign of shift. You can combine these sightings with monthly pivots. If you see price striking the second or third deviation band exactly at a monthly pivot, that's a potent combination for a reversal. This is how you determine the trend stages. Price near the middle band means a potential consolidation or transition area. Price crossing below the middle band means a shift from bullish to neutral or even bearish. Price crossing above the middle band represents a shift from bearish to neutral or bullish. One approach is to trade bounces off the middle band in a trending market. For instance, if the market is going up, you watch for price to pull back to the middle band. If price prints a bullish candle there, you buy, aiming for the upper bands as future target. Another approach is to fade an extreme if you see a strong reason. Suppose price slams into the third deviation upper band. Then you spot a monthly pivot or a supply zone, a bearish reversal candle forms. You have multiple factors to short, expecting price to revert back to lower bands. Some traders prefer to trade with the trend, buying dips near the lower band of that trend. Others prefer to fade extremes, shorting near the top band or buying near the bottom band if the market is choppy. You decide which method suits you. A trending environment might reward you more if you buy dips. A range environment might reward you more if you fade extremes at the outer band. You can confirm whether the market is trending or ranging by seeing if price forms higher highs and higher lows, or if it just oscillates around the level. Look for candlesticks pattern if you plan to enter. If you see a pin bar near a band, that might be a sign of a potential snapback. If you see a strong engulfing bar that breaks above the band, that might confirm a breakout. Evaluate the candle volume if you want an extra clue. Sometimes price breaks out and just keeps going. Bollinger bands widen. The third deviation band is not guaranteed to cause a reversal. If the market experiences a major fundamental push, it can ride the outer band for days. So don't blindly jump in just because price touches an outer band. Pair it with additional context. In this example, the market is trending upward. Price keeps bouncing off the middle band. Each time it dips to that band, we see an increase in bullish momentum and price resumes upward. So a good swing trading approach would be buying at the middle band, taking partial profits at the future resistance bands. In this example, you see a market stuck in a range. Price tags the lower third deviation band near a monthly pivot. A big rejection candle forms. The correct trade is a buy one, anticipating a return to the middle band. Another swing trading strategy involves monitoring a channel formed by the 21-period exponential moving average. The 21 EMA is a favorite among swing traders looking at daily charts. It reacts relatively quickly while smoothing short-term fluctuations. In this setup, you create a channel around the 21 EMA. That can involve plotting an EMA of the highs and an EMA of the lows. So you get two lines that frame price. This acts like a dynamic band of support and resistance. On its own, this channel might not be as reliable, but in combination with static support and resistance level, like round numbers, this channel becomes very important. Many traders fixate on these levels. They often place stops or entries around them, so price can pause or bounce at round numbers. Sometimes big players place large orders there, turning them into supply or demand zones. If the price is above the channel, you might see a bullish environment, so you look for long trades at the next round number bounce or break. If price is below the channel, you likely see a bearish environment, so you aim for short trades. First, check if price is above or below the channel. If above, the trend is presumably up. If below, the trend is presumably down. If price is inside the channel, it might be consolidating. Then you see where the nearest big round numbers lie. If the market is in an uptrend, you might plan to buy a breakout above the round number. If the market is in a downtrend, you might plan to sell a breakout below a round number. The channel can also serve as dynamic support or resistance. If price keeps bouncing off the upper boundary of the channel, that can confirm bullish momentum. If it keeps failing at the lower boundary, that can confirm a downtrend. Sometimes, this channel acts as a trampoline. Price will break through, come back to test an EMA line, and bounce away if the trend is intact. If it fails to bounce and instead lingers, that might signal a shift. The first bounce is important. It proves that the channel is being respected. Then you look for a round number to align with that bounce. That confluence can yield a strong trade. For instance, a bull trend brings price to the top of the channel, near a round number. If you see a bullish candlestick bounce off that zone, you jump in. You place a stop under the channel, and you target the next round number above. If price meanders inside the channel for more than 3 candles, you might skip trades. That indicates indecision. It's possible the market is waiting for news, or liquidity is low. You can wait for price to break out of the channel with conviction before acting. If you trade while the market is stuck, you might get whipsawed. That's why the strategy says to watch for immediate rejection or bounce behavior. You want clarity, not sideways chop. So here's the plan. You identify the overall trend with the channel. You find the nearest round numbers. You then wait for price to approach that round number with the channel as a guide. If the trend is up, look for a break above the round number or a bounce near the channel that aligns with that round number. If the trend is down, look for a downside break of the round number or a bounce from the channel's underside. You can also trade different combinations using all the tools and indicators we've talked about. Some traders run into monthly pivots that coincide with a round number, or they see that a Bollinger Band extreme lining up with a round number. Maybe price is at a monthly pivot at the third deviation Bollinger Band, or price is in an uptrend, holds above the monthly pivot, and sits near the 21 EMA channel. The more confluence you have, the more conviction you might gain. Your job is to read the bigger story. Are we near a strong monthly pivot or a known supply-demand zone? Do the Bollinger Bands show an extreme or a comfortable trend push? Are we flirting with a big round number? If multiple elements line up, you have a potent setup. Imagine you start your swing trading routine on a Sunday. You check the weekly and daily charts. You note the monthly pivot lines. Then you switch on the 3 Bollinger Bands. You see that price is currently near the middle band, slightly above it. That suggests a bullish posture. You may notice a big round number, which may or may not align with the monthly pivot. Then you track the candles to see if a bounce or a breakout occurs there. This approach is perfect for beginners or traders that don't have much time to trade. You do not rely on guesswork. You have specific levels to watch: monthly pivots, Bollinger Bands, or the 21 EMA channel. As a swing trader, you can check the chart once or twice a day. You do not need to watch every minute. You can quickly spot potential setups, place alerts, and plan your trades in a structured way. Sometimes you see many lines, the pivots, the channel, plus multiple round numbers. That can clutter your chart. You must prioritize. If you're aimed at a bullish trade, focus on major support pivots or lower band, not everything. If it sets up with a clear confluence, like the pivot plus a round number, then that's enough. Do not chase every minor pivot or Bollinger Band, and plan your trades in advance. Wait for price to come to your zone. Then watch for a candlestick pattern that confirms your direction. This patience can help you avoid random trades that do not align with your strategy. Some swing traders like to check if there is a big economic event or an earnings report for the market they trade. They still rely on their pivot or Bollinger setups for entry triggers. You decide how much fundamentals matter to you. Some prefer pure technical reading. Others keep an eye on the calendar to dodge big surprises. That is personal preference. Now, on daily or 4-hour charts, the candle close can be pivotal. If you see price bouncing off the pivot intraday, but the daily close fails to hold, that might be a warning sign. Wait until the close might confirm the bounce is real. That's how you filter out noise. For instance, if price wicks below the monthly pivot, but closes above it with a bullish candlestick, that pivot bounce is more convincing. If price wicks above the pivot but closes below, that is a fail. The same logic goes for the 21 EMA channel. If price intraday dips inside the channel but then closes back above, that might reinforce the uptrend. If it closes below the channel, that might be a shift. In practice, you can scroll through charts from prior months. You can see how the monthly pivot lines shaped the market. You can spot how many times price reversed near these lines, or how breakouts occurred. Then you can plot your Bollinger Bands and watch how price interacts with them. Do you see consistent bounces off the middle band? The same goes for the 21 EMA channel. Observe and note how often price bounces off the top or bottom line. Now, here are some potential pitfalls you may encounter and their solutions. First one, overcomplication. If you try to watch too many lines, you might get confused. So simplify. Choose only one dynamic support and resistance zone. Choose between the Bollinger Bands or the EMA channel, and focus on the zones with the highest overlap or significance. Another pitfall is not waiting for confirmation. Jumping in without seeing a candle close might lead to fake outs. Wait for that bounce or break to confirm. Most common problem is fading a strong trend without care. If price is rocketing upward, you might not want to short just because it hits the outer Bollinger Band. Check if volume is still surging, if the pivot is truly holding, or if there's a supply zone. Another problem, when swing trading, you'll have a tendency to let your losers run. I want you to respect your stops. If price breaks the pivot you used as support, let it go. The initial idea is invalid. Sometimes you'll face a gap open or a surprise news event that sends price far beyond your pivot or your Bollinger Band. That can happen after weekends or major announcements. In that case, reevaluate. If price already soared past your pivot, do not chase. Wait for a retest or a new pivot to form. Swing trading thrives on patience. You do not have to be in a trade every single day. Another challenge you'll face, especially if you're used to day trading, is the impulse to act onto every minimal movement. Swing trading calls for a calmer state. You don't need to act every day. You pick your level. You wait, sometimes multiple days, for price to get there. You see if it sets up. If not, you skip it. That's the discipline part. Another psychological element is trusting your pivot or your channel. If you set your stop under that pivot, do not move it if price is approaching. If the pivot fails, then you accept the loss. That's how you keep your risk controlled. Emotional changes to your plan might cause bigger losses. Handling emotional swings is another challenge. You might see a position in profit for a few days, and suddenly the market retraces. If you are not used to this dynamic, you could panic, but these swings are normal in a multi-day trade. That is why you trust your pivot or your channel. If it holds, you stay. If price breaks, you exit. Many traders even set alerts so they do not watch every candle. They just get notified if price hits a pivot or breaks a channel. Another challenge will be finding the correct exit points. One method is to aim for the next pivot level. If you bought near the main pivot, you might target R1 or R2 if the trend cooperates. If you shorted near R1, you might target the main pivot or S1. Another method is to use the Bollinger Bands. If you fade an extreme near the third deviation band, you might aim for the middle band. Keep a record of each swing trade. Write down the reason you took it. Did it rely on the monthly pivot plus a round number? Did it rely on a Bollinger Band bounce? Note your stop, your target, and the outcome. This helps you see which setups produce the best results. Over time, you refine your approach. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.